Good morning, everyone. It's 9 o'clock, so we'll start the meeting of the Finance and Performance of the 6th of August 2025. The writing instructions are for today that we'd like to be finished by 11. We're going to take all the papers as read by the staff, and the staff will provide comments, and we will, of course, have questions. So, as per usual, we're starting with the karakia, and Alison's expressed an interest in doing that this morning, so thank you, Alison.
Thank you very much, Grant. If everyone would like to join us in the karakia this morning. Whakataka tuho ki te uru, whakataka tuho ki te tonga, kia mā, utu, kia mā, kia te kere, ihi, hiku, te hau, te he, moiri ora.
Clearly more practice required, Alison, so next time we'll have you again. Thank you for that. Apologies. We've got an apology from Councillor Lyle. Is there any other apologies that are noted? Councillor Mugford, does anyone know? No? We'll put an apology for lateness for Councillor Mugford. I'll move from the chair. They be accepted. All those in favour? All right, carried.
Grant,
Thank you.
I can't tell, Grant, if Shane's in the room, but Shane is an apology as well.
Okay, thank you. Thank you. The Mayor adds Councillor Epiha as an apology. He'll be added to that list. Identification of any extraordinary business. I haven't been informed of any, so we'll carry on. Conflicts of interest are as per stated. There is nobody for our public forum today. We move on to confirmation of minutes on page 5. Do I have a mover for the minutes, please? Councillor Glidden, seconder. Councillor Reid. Any matters arising? All those in favour, they be accepted. Aye, thank you. Actions on page 13, I just spoke to the CFO. They will either update that or delete that because it's expired that date, so we will move past that. We've got the committee's terms of reference, which we all know about. Chairman's report, as being a stand-in chair, I don't have a verbatim report, and the Councillor Epiha hasn't given me anything that he'd like to speak to. I'm going to incorporate the CFO's verbal report into her first paper opening on page 23. So if you'd move to page 23 of the Finance and Performance Report, we're going to take that one. Thank you.
And Becca and Neil will present that. I think just for a point of reference, these numbers are in draft just now. They are subject to audit changes and any other changes that we make. Draft. This is standard in any organisation that these are draft results as at this point in time. Hand over to Becca and Neil. We're not going to have a break between the P&L and balance sheet, so we'll just go from one to the other, and just noting again that DC's is a separate paper, so if there are any questions in that, I would ask that we hold those until we get to the DC paper. Thanks. I'll hand over to Becca.
Good morning. Welcome.
Morning, can you hear me?
Very well, thank you.
Cool, thank you. I just want to draw your attention to the draft results for the operational summary. We have made some changes, so it kind of aligns to the balance sheet space, so hopefully this was a little bit more readable for you this time. But again, any feedback is appreciated on this. The overall operating performance was at 30 June, a 39.9 million, under budget by 4.1 million due to the lower than budgeted development contributions. That will be obviously discussed in the DC paper. The council draft operating surplus, excluding those contributions, was 9.5 million favourable to budget, which is a great result. The development contributions were 13.6 million under budget due to the utilisation of lower rates from the previous LTP, and this will be covered again, like I said, in the DC paper. Key variances for the revenue. The draft end of year result for revenue, excluding the development contribution, shows 188.4 million in the total revenue against a full year budget of 182.5 million. This is a result of a 5.9 million variance. The key variants in this area relate to fees and charges. The variance of 7.2 million is received in revenue, with the main drivers being in building and resource consents, refuge fees and building accreditation levies. And it is to be noted that there is a 2.5 million of that variance which is to be offset against additional expenditure in the consulting space. I will cover that again in the expenditure key variances. Investment revenue, the variance of 2.2 is relating to a higher than budgeted dividends from Cord and Orion. The remaining balance is from increased interest revenue cash balances on hand. The key variances in the expenditure. The actual expenditure was 173.2 million against a full year budget of 176.9 million, which resulted in a 3.7 million variance. Consulting, legal and professional services, I draw your attention to the table that we have given you, which gives you the split, but the variance of 3.4 million is over budget due to the higher than planned costs in the area. The breakdown shows that consulting fees are the largest component, and it's to be noted that the 2.5 million, as previously mentioned in fees and charges, is the variance to be offset in the revenue space. The table breakdown we have provided will show you that, I apologise that the point of clarification, it did say that the bottom line was talking about the legal professional services net. It actually relates to the consultant expense only. So hopefully that made a bit more sense. I apologise for that confusion. In the other expenditure, 2.2 million under budget across several expense codes, including lower than budgeted building authority levies. It's due to the levy threshold changes in legislation, water quality monitoring expenses yet to be received, and a higher annual engineering recovery against capital projects. In the operating projects, the main driver of the 5.6 million variance is in the realignment of projects being redefined as expenses as part of the financial hygiene project and project underspends across other departments. The largest of those projects is 1.3 million in the ecological land drainage projects, of which there are a number, underspent due to delays in pending resource consent applications with the Regional Council.
Just to echo what Becca said, we do appreciate the feedback from this committee, and we try to incorporate it in our reporting, and as such we've taken the request to include more treasury reporting in the balance sheet section, and we've done so happy to take more feedback on that. As of 30 June 2025, Council held $61 million of cash and cash equivalents. This is higher than budget, but this was due to more favourable interest rates receivable on cash balances versus the interest we pay on our borrowings. We also had to consider early debt repayments, early termination costs, and decided that was not favourable for Council. Also considering the fact that for year end we do expect higher than normal capital claims due to all of our vendors trying to get their bills in for the year end. And I'm happy to report that the cash balances retained was sufficient, and within 2 years after the month-end close, cash balances returned to the budgeted amount, so we had sufficient funds available. Property, plant and equipment of $2.9 billion increased with $129 million, which is an accurate reflection of capital expenditure less depreciation. The $211 million variance to budget is mainly due to asset revaluations still to be processed as part of the year-end process, and that will be reflected within the annual report. Trade payables and revenue received in advance of $51.8 million have increased by $11.5 million for the year, as noted with cash and cash equivalents, higher capital claims, and the improvement of accrual accounting ensured that all goods and services delivered were accounted for. For borrowings, the total balance of $2.89.4 million under the non-current borrowings ended up $4.5 million under budget, and this is due to lower than budgeted capital expenditure offset by the higher cash balances retained and lower DC receipts. Open to take any questions.
Questions from councillors? Councillor Glidden, I think you...
I am. I'm just finding my page here. Just on the operational summary, and was a pet favourite of mine. So $2.5 million in fees and chargeables are rechargeable to consulting, legal and professional. Fully understand that. It's great. That leaves us $1 million over budget for end of financial year. So I just want to understand over the year how that happens with process because to me it's seeming it's an accumulation that's leaving us to track over budget of lots of little things. They're not substantial big things that would see a delegation come back to us for approval. So I'm just thinking about council process and how we work through that to actually stay within budget a little bit more, because if that was, the $1 million was outside of budget, that would have to come back to us for approval. But because I think we're seeing a lot of small accumulation that has been approved within delegations, but it's compounding to be outside of that.
Thanks, Lydia. So, I mean, what we've got within the consulting space is where we've had to hire consultants where we've not been able to hire resource. And I think we've sort of spoken to this previously in this meeting as well. Certainly in the planning area, in Bob's backyard, and digital as well, where we brought in consultants because we don't have the resource in-house. Certainly going forward, this is one area where we will be looking at closely to make sure that the spend is measured on a monthly basis, reported through to here, with clear line of sight around where those variances are, if there are any. But in this financial year, I mean, sometimes we do need to hire a consultant, we do need to engage contractors. It's the same in any organisation, but I mean, certainly controlling the cost is key, and I appreciate that.
And I'm not against hiring consultants, because I understand that you need people to do specific jobs and for specific outcomes. But if we're saying that we don't have the capability, wouldn't we have seen the budget through personnel costs associated to that?
So our personnel costs, and I think we've spoken to this as part of the annual plan as well, there is additional resource that we've had to bring into the organisation across a number of departments, so that it's not an obvious direct correlation between one and the other. So our payroll budget is broadly in line with what is shown in the report, but certainly if we look at the annual plan, the cost base in personnel is higher, and if we reverse engineer that, that is roughly where we're bringing the consultant spend in. Happy to report this in more detail in future reports if that helps.
That would help. And I have some questions on the balance sheet. Would you like those now? So I looked at the borrowings, and you're saying that we're under 4.5 million, and you did a brief explanation on that. I guess I sort of looked at that I would have seen we would have been $12 million under budget because of our capital expenditure not being delivered, or value engineering on that, because I would see that at the end of the program most of our capital expenditure would be debt funded. And the other question was, I had looked at the Treasury report from Audit and Risk yesterday, and so the Treasury report shows total borrowing of 295 million, which is 110 for the year, but the balance sheet is showing 289 million, so up 94 million for the year. So I was just looking for the difference between those two.
Correct. So to answer the first question, in terms of borrowings, the under recovery in development contributions for the year is a balance of development contribution project spend. So typically the infrastructure is required before we see the growth and the additional UE applications. So we have to fund the infrastructure being built with borrowings, and then quite often the DCs are recovered after the fact. So the under recovery in the DCs have an effect on what we're borrowing for. So that, like I said, that's part of the offset in the borrowings, bringing down that $12 million variance that you're referring to. And then with regards to the total balance of 295 as per the Treasury report, so we note that in the line item in the balance sheet it is borrowings and other financial liabilities, and then it's also split between current and non-current assets. So there's some derivative financials in there as well that still need to be finalised as part of the year-end process. But as per our Treasury reporting, that's taken directly from Power BI dashboards that we get from PwC, our external consultants, and we have other verification methods with Hedgebook and the LGFA in terms of what we are borrowing sit.
Okay, thank you.
Kia ora. I have a couple of questions on both the balance sheet and the P&L. So with the P&L, just some really broad questions. So when it comes to the over budget on the consultant legal professional fees, I just wanted to know, like, why, and was any of that related to any overspend in the local Waterdown well work and the establishment of the CCO?
Megan, I'll answer your question on the water. So the water spend, so there was a 2 million establishment budget set up to June 30th. Those amounts are actually sitting in our balance sheet. They're not reflective in our P&L. So their spend up to the end of the year was in keeping with that 2 million establishment budget that was set. I'll leave the rest of the questions for Becca to answer.
Sorry, can you, excuse me, can you just repeat the bit that you wanted me to answer? Sorry, Alison.
Okay, so as a broad, why is the consultancy legal up? And the second part is, was it related to water? And it's not related to water. There wasn't an overspend there, so why was there such a higher rate for the consultants? And I know that some's been offset with charging directly against revenue, but
There were,
what is it?
we had offset we had outsourced some of the legal fees at the beginning of the year. That's changed. We've got an in-house legal team now, so even though we started the year off, probably with some higher costs in that space, but if you want further detail around all of the actual full level detail, I will provide that to you offline, if that's okay.
Yeah, no, I just want to know generally, why were we spending more there? Because, so if it was because we didn't go in-house, but we budgeted for in-house, and then we used external instead because we had a lag in recruitment, then I just want to understand, like, why was it a $3 million difference? It's quite a substantial.
So I think Megan has sort of answered that question to Lydia. So the paper, we've got the 2.5 million offset within the consultant against the revenue line, which leaves the 1 million overspend. Like I said to Lydia, we have used the consultant budget, or we've used the consultants to backfill some resource that we have not been able to fill in certain areas in the business. That wasn't budgeted. This is a growth area. We have struggled to find staff in certain areas, so that has been used. Our staff cost budget, if you look at the annual plan, is significantly higher than what these numbers are. So whilst the personnel budget is broadly in line, it's not telling the full story around how we have to use consultants in some areas. So it's very similar to how I responded to Lydia. We can break it down in more detail if that's helpful. We don't have that detail to hand at this point in time.
So I might summarise, as I think the two questions are linked.
Yeah.
I think what the members are asking for is a breakdown of how much of legal consulting, like engineering consulting and accounting consulting, is breaking down to broad groups. The second question that Lydia is asking is, does any one of those particular groups go over the threshold where it should come back to governance for further funding requests, rather than having incremental cash being spent all the time? Where's the cut-off or the cash flow forecast in advance where we need for increased budget? So that's what I understand the two questions to be, is let's look at the broad groups where it's been spent, and let's understand the budget attached to each group. Am I summarised what you're asking?
Yes, but also one other thing. I expected offset.
Yeah.
So the 2.5, I expected that. I don't think that. I think the additional 3 million, it's a red herring to say it's offset, because you always offset some of those consultancy fees in the consenting space in particular, or planning space. But I'm trying to uncover, do we have an issue here where we don't have enough staff, or is it that we don't have enough people applying for the roles? Like, really, at a high level, what is going on, and what are the numbers telling us about this entity in terms of performance?
So in summary, in terms of the payroll budget, we did not have enough staff. We have used consultants to backfill where there have been gaps, and we've also used consultants for vacancies that we've not been able to fill. So we've talked to that in previous reports as well. As far as that broader breakdown in consultants in terms of that $1 million, we will expand that information out and bring that to subsequent meetings. To Grant's point, we do not have that breakdown available at this point in time.
Okay, clear explanation, thank you for that. I think if you just refer to page 25 to that table, it talks to net consultant, legal and professional services, which to me bundled up as consultants because they are outsourced requirements. That number's as suggested is incorrect. So like in the first column, the costs are 9.6 million less, a recharge of 3.4 equals 6.2 million net, not 4.6. So that's where and that's, the staff have explained why that's happened. But if you're truly looking at as outside services contracted in by council, it's 6.2 million, not 4.6, I should say. or 4.7 in actuality. So let's leave that for the staff to report back at a future date. It'll be on the list of items to be brought to the next finance and performance meeting. Thank you for the explanation. Are there further questions, Member Mackay, from your state? You're okay?
Yes. Yep.
Yes.
So, so my next question is around the operating projects, and there it is. So page, the comment that was made, the comment in this paper on, so page 26. I'm just having trouble trying to get to the page. Operating projects, 5.6. So when you, this is on the, not the balance sheet, it's on the P&L. So when you talk about the 5.6 variance, and that's a realignment of the hygiene project and being redefined as expenses, look, I don't quite understand that. Like, how was 5.6 realigned into what?
They were moved from a line that was talking about projects and put up into where the expense actually should be sitting. We've just redefined some of our projects. There may have been things that were classed as, for example, say maintenance in a project line, and we've moved it to show it sits against the maintenance charges. So it's just a redefinition of those charges, and we've moved them around.
Okay, so who decides what's a project and what's an operating expense? Like, how are those decisions made?
So I think just adding to what Becca said there, historically we have had operating projects which are not a project by nature. Rebecca's just alluded to adult repairs and maintenance being an example, and there's many in there. To truly measure what is the operating cost of the organisation, you have to split down those operating projects and reflect them in the correct category in the expenditure section of the P&L. So it's not necessarily a case of how we're actually defining them. It's good practice to have those recognised. So if we have something sitting in operating projects and we're looking at, say, repairs and maintenance for the organisation, and that has got, say, 5 million in one bucket and 5 million in another, we don't have a true understanding of the repairs and maintenance that are required to maintain our equipment or plant, whatever it may be. So it is appropriate to reclass those items. In the past, they've been incorrectly classified, not just in this budget, in previous as well. In part of the financial hygiene project has been very clear to make sure that we are recognising the cost in the correct area.
And so is that financial hygiene project now complete so we can have confidence in the budget moving forward?
It's mostly complete. We're still looking at our GL codes. We've still got too many GL codes. This was never going to be a 5-minute unfortunate project when you start off with 25,000+ GL codes. And actually looking at how things have been classed. So for the purposes of where we're at June 30th, we are comfortable that the numbers are a true reflection of what they should be based on the category of expenditure within the P&L.
My last question was about the balance sheet, and it's actually related to, also relates back to the P&L about the other gains. So in the balance sheet where it talks about property, plant and equipment, we would have been in the subcommittee on economic development and investment.
Sorry, guys, we can't hear anything online if people are still talking.
I think your button is off, Megan, unfortunately.
It just seemed to turn off automatically for some reason. I don't remember turning that off.
If I turn
Yeah,
Sorry.
try again. There we are. Thank
Yep.
you, Megan.
So the last question I have is about the property, plant and equipment. So when we've been at the Economic Development and Investment Subcommittee, we've been told that we don't have yet a full oversight of all of our property, like land-based property and other property. And I'm trying to go, well, how do I have confidence here in these records if over there we haven't been able to make decisions about investment and disinvestment because we're still doing the unpicking of what we own? And then I related up to the comment on the P&L on other gains that it relates to the gains on sale of assets and investment revaluation. And So it's difficult to hear in a subcommittee. We don't have really good understanding of what our assets are, and then to see it represented here. So how confident are we that this balance sheet actually does represent our assets?
I think there's a couple of different things in play here. When we look at it from an economic development committee, we're looking at what assets we would look to potentially put in a pool for divestment. When we look at this from a balance sheet stance, so we are comfortable, and bearing in mind these numbers are audited as well, that we are comfortable that we're accurate reflecting what is our property, plant and equipment balance. What we've got in this balance is a grouping of assets that historically have been put into a fixed asset register as a group. So what we need to unpick is what is the components of these assets. So the overall numbers are correct. And when Rebecca and Rob have spoken to this at the economic development, it's the unpicking of that around the classification around what would be held for future divestment, if anything. So the overall number is correct. It's the how we decouple some of these balances. Does that help with your understanding?
Yeah, I'm trying to use this information to understand what we've been told, obviously there.
Yep.
And if we have a list here, I don't understand why we can't see that list there.
So to provide like a very high level example, so if we look at some of our buildings, we've recognised it as a building. What we've not recognised is some of the plant and equipment that sits within that building separately. That's just one example. So in terms of that, how then do we decouple these amounts and make sure they're classed separately around how we would then treat that as a potential divestment? So the overall number is correct, that's subject to audit, it's been valued, etc. But it's the decoupling the line items that then gives us the visibility of what would then sit as a potential list of assets we would divest.
Right, okay, that's not my understanding of what we've been told. I haven't been told anything about decoupling. I've been told that we actually don't have a list.
That's not the case. We do have a full list, it's the decoupling. We're very clear on that point.
Okay, well, I think that committee's now at an end anyway. Thank you.
I think Councillor Hassan was next.
Thank you. I'll start with the operating projects as well. I was interested to actually read about the 1.3 million ecological land drainage projects underspent, and then it says that it's pending on resource consent applications from Regional Council. Now, I thought for land drainage, yes, we do need resource consents, but they were going to be undertaken as a global consent across all the land drainage projects that were actually happening. And I would actually say that that, to me, would be a separate line item than the projects at 1.3 million, which is the ecological land drainage projects. And the ecological land drainage projects, I would understand to be works in the Selwyn River with regards to planting, and they are costed not necessarily from the land drainage account, but the accounts that are collected outside the land drainage for trying to assist some of those projects. So we were looking at really something really broad, but we're trying to offset it against the resource consent. To me, that doesn't make sense, because one we've got to do, which is operating. The other falls into a project that could almost be classed as a capital project, because they're new projects to assist with our One Water strategy. And we don't, unfortunately, we haven't had a land drainage meeting to actually at least have an opportunity to discuss this with the chairs of the land drainage. And we don't seem to have where this would fall with regards to our subcommittees for reporting back, if it's not a full report back to council.
I think in this instance, Councillor Hassan, the staff are telling us about the major item within that budget, the 1.3. It's not digging deeper down as to where it should be applied and the reason it's being held back. It's just a note. Is my assumption. Is that clear?
Yeah.
Okay. Sorry,
I was just saying that there is actually a gap in somehow reporting the information that we're finding here through the subcommittee structures.
Thank you. Thank you for bringing that to our attention.
There's another question that I actually have, and excuse me, this comes back from being at audit and risk yesterday, and it's our borrowings. And I just want to understand that we have a staff estimate of our borrowings, and then we have the actual borrowings, and the graph that was shown, which is not on this agenda, is quite a variance with regards to where we started within this project of where our borrowings are sitting. We're transferring some of those assets across to the water services. How much are we transferring across, and how much will that affect the variance for next year with regards to our borrowing? Because I'm starting to get really concerned at our borrowing cap that we actually have. If we transfer assets to water services, that should actually lower the borrowing cap that we actually have. So understanding what that split would be within the total rates would be very helpful going forward for another meeting.
So just for clarity, you're asking the staff of the projected balance post waters decoupling. Is that the question?
Yeah. Yes.
Are you able to answer that, or not yet really in a position to answer that?
So at a high level, yes, balance sheet separation is required. I can let Alison talk more about maybe the timing of the completion of that, but in general, yes, you would need to do balance sheet separation, which basically splits the assets as well as debt between water and wastewater related or Selwyn Water Limited assets and debt versus Selwyn District Council. We would definitely need to relook at our whole borrowing structure, how that is fixed, and the caps. But for Selwyn District Council as a parent entity, we are currently operating within our LTP limits of 220%, and we have the ability to increase that to 280%. But we know we're close to those debt limits at this stage, and once you've done the balance sheet separation and transferred debt and assets, the debt for council should reduce.
And the CFO wants to make a comment as well.
Yeah, and I think just at a high level summary, I mean, we're working through those numbers just now, but any of the assets associated with what's been transferred will be moved across as Neil talks to. Any of the associated borrowings would also be transferred across. That will present a different debt headroom picture. We don't have the exact numbers yet because we're not there. That won't happen until Bill 3 is legally enacted. That will be the point when we transfer the assets and any of the associated borrowings. And it'll be assets that are either constructed or under the course of construction.
It could be helpful. The question has been raised a couple of times about the differential between the debt balance in this report being $94 million increase since June 24 versus the Treasury report of $110 million. Could you please just elucidate that? Is that just a timing issue?
Correct. Yeah. So the opening balance of your budget will be based on preliminary closing figures before you go out for consultation on your annual plan or LTP in some years' cases. So you do have a inherent opening balance variance.
Sorry, Neil, we're just talking to the difference in the debt number from the Treasury report to what's in this paper.
Correct. At the moment, it says from June 24 in this report, our debt levels increased by 94 million. In the Treasury report yesterday at ANR, it increased by 110 million. So there's a $16 million differential between the two debt numbers that are reported. I'm assuming that's because the Treasury report is more current.
No, as mentioned earlier, there will be financial instruments that could carry debit balances to be updated with credit balances currently still sitting in the balance sheet reporting within Magic, but updated in the annual report process. That is the only reasonable explanation I can provide at this stage. Like I said, we do provide reporting of actual Treasury
That's
reports.
how I took it, because it's to June 25, and from June 25 to now will be the increase of 16 million, I'm guessing. Yeah, okay, there's nods going on. Sophie, Councillor McInnes.
Kia ora team, thank you very much. Some of the questions I had have already been answered, so I'll just stick to the other parts. But also, in terms of the ecological land drainage projects, my assumption was that those were basically projects that we had in the LTP, and it's just that they're being held up by resource consent rules. So not specifically One Water strategy related, like it'll be part of it. Like some of it is just the usual renewals and maintenance of several land drainage schemes?
It's a broader question that
Yeah. That's
that IMP would need to dig into the detail on, so we don't have the full detail on
Cool.
just now, Sophie.
probably not relevant to just here. Sorry. So one question was in expenditure and other expenditure. It says we've got lower than budgeted building authority levies because of the levy threshold change. So that sounds like something that's been driven externally, and obviously you can't change it because somebody else sets those rules. My question is, are we okay with accommodating that into the next year's budget as well? Like, is there anything else that we know of that might have been impacted? Because when we had the numbers, then somebody else changed the numbers that feed into how we have planned the budget.
As far part of this year's annual plan, everything we're aware of has been built in where we can.
Yeah. Is it a significant level of change that's going on there? Because obviously there's lots of reforms and things going, and a lot of them don't even hit the news. So just wondering how much has been impacting our budget with these sorts of things.
Like, I think what Becca's sort of alluding to, the annual plan is based on the information that we've got and what we know at a point in time. We appreciate there's a lot of reforms going on in that space. Some of those reforms will not be reflected into those numbers because we don't know the full extent yet.
Yeah.
So it's based on what we know at the point in time.
Okay, thank you. And I'm not sure if anyone can answer this, to be honest, but another question is around...
Thank you, Councillor McInnes.
Apologies. Trade and other receivables, there's the note around the $3 million claim from NZTA about the May flooding event. And I'm just wondering if anybody is feeling... How hopeful we're feeling about that claim being granted, given that since then there's been Nelson Tasman happening, and the government have said that they've got a bit of a limited pot for emergency works these days. I don't know if that's a Tim question. Tim's shaking his head.
Yeah, it probably is a Tim question, Sophie, and I don't have an answer for you at the moment. We're still working through that.
Okay, so Tim's microphone wasn't on. He said we don't have an answer for that just yet. So thank you very much for the insight, and that's me done. Thank you.
Thank you. Thank you for the report. I really appreciated the graphs on page 29. Just one last question from me around just the bottom left-hand corner of page 29, talking about rates owing at June 25. The substantial increase, is that just because rates invoices have just been issued and they're not, so that's not an indication that we've got a significant portion of rates outstanding?
No, it's just that they have just been issued, so it's fine.
Right, very good. Thank you very much for that. We will now move on from that to page 30, which is Development Contributions Briefing, and I'll pass to the CFO for comments.
Yeah, so the purpose of this briefing that Neil, Rachel and Peter will talk to, this is a follow-on from the conversation at the last finance performance meeting. So what the team will take you through is just the current state, illustration of the calculations, etc. But I think it is worth noting that any deficit that we are currently reporting in DCs will not be picked up by ratepayers, and Neil will talk to that in more detail.
Welcome, Neil. The floor is yours. Again, reiterating that the paper is taken and is read, it's just highlighting points that you want us to provide clarity for.
Thank you. So in the briefing pack circulated, we tried to provide an overview of the current state, how the current policy works, how it's translated into a shortfall for the financial year ended 30 June 2025, risks identified and options for consideration. I'd just like to reiterate the fact that the figures disclosed in the briefing pack and the DC movement report, which Peter will present after this, are all draft figures and subject to year-end procedures and audit. The DC financials are also covered in more detail, as I mentioned, and we'll discuss that in more detail. With regards to the policy, we noted that it is required under the LGA. It was last reviewed for the 2024-34 LTP. It was subject to legal review, and the DC rates were recently updated as per year 2 of the LTP after the FY26 annual plan was adopted in June. We provided some examples of when DCs are triggered, and we also provided examples of when those invoices are issued, noting that the DC rate is reflected as at the date of that trigger. We provided high-level calculations of the sewerage DC as an example to reflect all the factors that are considered in the DC rate, which is life-to-date opening balance resulting from over or underspend in recovery. So, for example, if we've under-recovered for FY25, that under-recovery will go into the opening balance and will be considered with the next rate refresh and therefore recovered in future DC rates. The forecasted cost of growth over the next 30 years, the expected housing unit equivalent, or HUEs, as we refer to in the rest of the briefing, per growth modelling, and then also the fact that we do split the total recoverable cost to get to a reasonable increase, because it won't be reasonable to increase the DCs by the total 30-year cost of growth. Then also the interest component, due to, as we mentioned earlier, due to the natural timing difference between the requirement for completed infrastructure versus those additional growth HUEs coming online, we need to borrow up front to fund that infrastructure. And then, as mentioned earlier, life-to-date under recovery is also factored into that opening balance on which we have to calculate interest. We shared some detail on a selection of 15 applications only received within June 2024, which is the last month before the LTP refresh. Those 15 applications came from 15 developers, stretched over 2,500 lots, and those 15 applications alone resulted in a $33.9 million under recovery for that financial year. But as mentioned earlier, that will be factored into the opening balance and recovered through future development contribution rates, and it does not put any more stress or is not recovered at all from the general rates. We also identified some opportunities to address the risks identified in the briefing paper. In the short term, opportunities include Council considering reviewing the policy, including the rates and terms more frequently, as opposed to with the 3-yearly LTP refresh. Reassessing discounts and credits, and part of that is also comparing our DCs in more detail to other high growth councils. Something else on the horizon is the development levy reform. Even though there's not too much detail out there at the moment, we can expect that to be applied around 2027, and we expect this to provide standardization, adaptability, and regulatory oversight, which would address some of our main concerns with current development policy and the LGA. Open to take any questions.
Sorry, thank you, Neil. Are there questions of the team? Beg your pardon. Councillor Munt, you were... Sorry, Deborah. What page? If councillors could reference the page they're speaking to, would be helpful for the other councillors too.
Okay. Look, first of all, I'm going to thank the staff, Alison and the team, for all the work that you've done with regards to reviewing the DC policies, how we collect, and for future reference, how we can improve. And I just really, really appreciate all the work that you've done. That's first up. I guess what I want to actually discuss was on page 33, because some of our biggest deficits are in sewage and water with regards to the underfunding, and they're going to be transferred across to water services. With regards to water services, is that going to alter, when these are transferred across, is that going to alter their bottom lines with regards to the the forecast that water services will have for charging? I know they can't charge the existing users, but how are they going to manage that deficit going forward? I mean, we don't have development levies. We're still going to be responsible for collecting the DCs. How's that going to shift across the debt balance sheet?
happy for Alison to add here as well, but I believe the that Selwyn Water Limited has the ability to adopt council's development contribution policy and rates, or to formulate their own DC policy. But yes, the balances will be transferred, for the DC balances will be transferred to SWL as well. And the recovery of it probably post 1st of July 2026.
I'll just add to that by saying it's sort of similar to the comment I made earlier with regards to transferring the assets and debt. It's something we're still working through just now. We don't have the exact numbers. And that's going to take time, and we won't be doing that until such times that Bill 3 is legally enacted. So that's probably around about the September point, Deborah.
Councillor Munt.
Page 36, when is the DC policy triggered? So we've got subdivision consents are generally valid for up to 5 years with a possible 3-year extension. And then obviously under the RMA 91, the developers can request a 10-year lapse period for consideration by the council. Just curious as to know how many we have on the books that have got consents that they're requesting a 3-year extension, and how do they apply for the 3-year extension? Is that something that we at council grant? And the same with the 10-year lapse period. What does that mean in terms of the DC collections?
I'm not a planner, so I can't sort of speak too much in terms of that, but I know that under the RMA they are able to apply for an extension of time for up to 3 years, and they need to show that they have given considerable progress to their consent. So there needs to be quite a substantial amount of work having given effect to their consent.
Yeah.
In terms of the 10-year lapse period, just of those 15 applications that came in June 2024, I think that there were quite a few that were applied for a 10-year lapse period. Of the decisions that have been notified so far, 3 that applied for a 10-year lapse period have only been granted a 5-year lapse period.
So who grants those?
It's a consideration that is given by the planning officer.
Okay. So how does that affect the DCs? Does that for both of those, does that mean that whatever DC policy price they locked in at the initial outset, that will continue on throughout that 10-year lapse period, and at which point do they need to pay?
So it's a 5-year lapse period that so far those decisions have been notified for. The development contribution is assessed at the date that the resource consent application is submitted, and that is the rate that is honoured throughout the life of that consent. After 2 years from the date of the original development contribution assessment to the time that we go to invoice, if it's been more than 2 years, then we can add a PPI adjustment, which is something that we do currently.
Okay, I'm just checking if I had any more questions, sorry, before we move on. Nope, I think that's all.
Councillor McInnes.
Yeah, thank you. So I guess I've got a few questions. One is between the date when the calculation is triggered and when the houses are actually built or it's invoiced and everything. If the subdivision plan has changed in the sense that the housing is more intense, for instance, like maybe a block of apartments, because we know that we've got other policy settings that are trying to encourage that. Does that form part of any recalculation of the DCs at that point?
I think there's sort of 2 parts to that. So we have the opportunity to do an assessment under a subdivision consent, and we would be assessing for that one piece of land which is being subdivided and created. If someone is then going to do a more
intense development on that land and submit a building consent for 3 dwellings, then we can assess under the building consent application also. So that's where we would capture those additional 2 houses that have been constructed, and that would be as per the time that they apply, or the rate and policy at the time that they apply for the building consent.
Cool. No, that's good. I was just hoping that the original calculation doesn't, that the only change available was the PPI, when potentially there's a whole bunch of other potential changes. So thank you. It's great to see that you've, the way that this is, the timeline of how this has transpired, you've obviously got plenty of ideas of how we can strengthen the next DC policy if that happens at any point. And it's good to have the details. It's kind of a shame that we've had these developers who have identified a nice little window in which they could exploit a loophole. Yeah, that's the market. I guess so. This is a bit of a crystal ball gazing one, but thinking in terms of the development levies that are proposed, I'm sure I've heard that potentially they could be retrospective as well, applied on subdivisions. And I'm just going to not really asking a question, it's more putting it out there that perhaps we need to signal that if that is the case, then because some of the DCs are absent on particular subdivisions where works were planned based on the numbers of houses that were being built in those particular places, those guys who are buying those houses will be very grateful, I'm sure, for the smaller DCs, but they are still part of how those projects were triggered. And if there's an opportunity to put some of the levies on those houses retrospectively to recover the costs that they have actually generated, then that could be something that that we may need to consider, which is always difficult because you don't know how you're going to inform somebody of that. This is, yeah, it would have been nice if they'd waited until after 1st of July. Thank you.
Councillor Glidden.
Because this is a briefing, we get to, I guess, give our view on this, and you're looking for feedback and steering from us in this. So it's page 47, which is the policy review. When reading this, I look at this and I think, actually, if we had have reviewed, and this is probably a hypothetical question for you, but if we had have actually reviewed the DC policy and had an annual plan this year, what difference would that have made? Because effectively I see that we are waiting another year before we can actually even do anything.
At a high level, that is correct. Unfortunately, we have to go out for consultation when amending this policy, as it has an influence on our capital program as well. So there is a process to follow that unfortunately takes time, and as far as I'm aware, we can only do that at most on an annual basis.
Yeah, so I guess my question was, is if we had have done that 12 months ago and made a change for this financial year, do we have any idea of what position that would have put us in? Instead of waiting, we've got to go through this process, we can't do anything until next annual plan.
I think, Lydia, I'm happy to respond to that one. So we've not done a full sort of reverse engineer of that hypothetical situation, so we're not able to provide a response to that.
Cool, that's okay. As I said, it's a bit of a hypothetical question of just trying to get an understanding of if we had have acted sooner, what position would we have been in? And
so the short answer to that is probably we're $4.1 million better off.
Yeah.
Carry on, sorry.
And look, I really appreciate all the work that has gone into this, because it has been a significant piece of work that you have undertaken, and it's great. It's giving us a better, transparent view of this. And so my questioning comes into the review of the current methodology and actually how much of the components are cost for a lot of our capital projects. And my personal feeling is that we're not pushing the boundaries on that enough. I know that we have legislation to deal with, and there is only so much that we can do, but you know, I use the Lincoln Lights as probably the most recent example of saying actually only 15% of that is for growth. Yet when I see that, I look at, well, the fact is that the developers need those lights in so that they can sell section titles. So should we be pushing harder on what that actually is so that 85% of that isn't covered as a level of service for current people because they already have a current level of service provided. So I think that we need to be pushing a bit harder on what the growth component is.
Thank you. Appreciate the feedback.
Thank you.
One of the benefits of being here a bit longer is you remember things from the past. And I think it's, given where we are today, it's probably, if you'd just indulge me, it's worth reflecting on the past, is that the ESSS, when it was originally built, we were the council, when I say we, the council was challenged around over-collecting DCs on that basis. And after a protracted, lengthy period, there was a refund of development contributions to developers who perceived had been overpaid. The very direct question was asked of developers at that stage, if the situation ever reversed, would you be willing to come and pay the extra? And they all nodded enthusiastically and said, of course we will, of course we will. And here we are in that position. And I was just reflecting on Sophie's comments. There's a great Australian word that's used a lot. These buggers have rorted us, which is what they've done. They might think it's clever business, but they have taken advantage of the system and not paying their fair share. And it should be flatly put to them, you're not paying your fair share. Because what they are doing is putting the cost of that, their, let's call it dividend, onto future section owners. So future section owners, instead of paying, let's say, 13,000, are going to pay 15 or 16 to make up what these beggars haven't paid now. I don't think it's acceptable. I think they shouldn't be lying in bed straight at night. They need to pay their fair share. And they've committed in the past to say, we'll pay our fair share, not try and rort the system. And, you know, that it is a significant amount of money. The challenge we put to the developers at that time as well, when we refunded that monies, is that, of course, you'll pass this benefit on to section buyers. And I would suggest the same to these developers. If they're taking a dividend from us, the section should be cheaper, not put in their back pocket. Whether that'll happen or not is probably a forlorn hope. But I think we should be running quite an aggressive campaign that these guys need to pay their fair share, not try and rort the system, which is what they're doing. It's all it is, a rort. So we will pause there. I can see I'm passionate on that point. Councillor Munt, I see you wish to speak.
Yeah, sorry. I had trouble highlighting some things earlier. So just in terms of page 47, where we're going to be looking in preparation for in 2026, the methodologies for DCs and assessing what's happening, benchmarking against other high growth councils. I think that's something that I'd like to know. How much are we aware of what other high growth councils are charging at the moment compared to us? Do we have an understanding of what that looks like so that we know whether we're in the
Councillor Munt, I might just interrupt you there. What other councils are charging is solely reflective of the infrastructure they're putting in. There's not benchmark to us at all, be clear. Okay, thank you very much. Everyone's all effusive with praise for that paper, and it really helped us understand in the wider community. Thank you for doing that paper, the team. I now move on to page 50, which is Development Contribution Movements, 30th June, and we have a recommendation at the start of that paper that we receive it for information. Can I have a mover for that, please? Councillor Reid, thank you. Councillor Hassan has seconded. All those in favour? Any comments you'd like to make or questions to that paper, team? Neil.
Good morning. Please note, as has been said before, these are currently only draft results, as they do not contain any of the year-end adjustments, such as interest calculations. For the year, we received 24.7 million worth of DC contributions, which was 13.6 million less than budget, and we've spent 54.1 million on DC-funded growth projects, which is 3.3 million less than budget. There's been no drastic change in the trends that we've been seeing throughout the year and that have previously been reported on. These movements for the entire year left us with a total DC balance of 3.4 million versus a budgeted 13.7 million. Once the interest is added back in, we see it being circa 800k uplift and bringing our DC balance up to around 4.2 million. Are there any questions?
The floor is open for questions on the DC contributions. There being none, Councillor Hassan, didn't see you, so my apologies.
Hang on.
Sorry, my apologies. Councillor Glidden is first.
And Mr. Chair, it's not necessarily questions on this, but it becomes really hard when you look at this information and there's nothing we can actually do about this right now until we review our DC policy. And this is where it came back of my question in the last paper is what could we have done 12 months ago to be in this space? So it becomes really hard to ask a question on a paper where I feel like we are completely hamstrung, but it goes back to the same question of we need to be going out and saying to our developers, you need to pay up.
Just
Because
for
we are in this deficit.
clarity, Councillor Glidden, I have spoken to management yesterday and this morning around the governance team being willing and able to undertake any activities to assist them to close this risk window. I've left that with the staff as to any opportunity that they may see. It is difficult when you're bound by legislative requirements, but they are investigating all opportunities to make sure that we do close that risk window as soon as possible.
Cool.
That's my understanding.
Thank you.
Thank you.
That's great. Appreciate it.
Councillor Hassan.
Thank you. My question, I guess, is on page 52, and I do consider these to be draft. I guess when we're looking at a catchment basis, and then we're going to go to development levies and targeted rates, and if we're looking at growth and we're looking at the targeted rates and the future of development levies, high growth areas will actually be ring-fenced to actually collect more money and on a targeted area get more infrastructure. That's how I see what's sort of futuristically being planned for. This will have a major impact on our low growth areas within our rural communities because this graph, table 3, really shows where you've got no growth. We are undertaking projects because we collect on a district-wide basis as opposed to ring fencing and looking at catchment basis and that growth. So futuristically, that could be a problem for us coming forward where there's going to be more demand for supplying services in high growth areas versus low growth areas. And I just want to, it's more of a statement, but I just want to capture that with where we're going in the future with looking at our projects across our district, who's going to pay and how we're going to collect those DCs to
Thank you,
offset.
Councillor Hassan. You've made a good point. Probably the logical place for that to go is the DC review, when it's reviewed, that DC policy review, and we noted your comments for that. Thank you for that. Is there any further comments? I think Councillor McInnes, for you? No? You've changed your mind? So we've had a mover and a seconder. There are no further comments. All those in favour that that paper be accepted for information? Aye. Ayes. Good. Thank you very much. We're now going on to page 55, organisational projects. Cameron Waugh and Peter Edgehill. So while we're waiting for the table, we've got a recommendation that we receive that report. Do I have a mover for that? Councillor McInnes, seconded Councillor Reid. So we're taking the report as read. Is there any comments you'd like to make on the paper?
Yeah, I'll just run through a few comments. Thank you. So this is the Finance and Performance Report for the end of the year, so end of 2024-25 year. I just want to make a note that we haven't made any further changes to the report, but if there are any changes that you want added, to let us know. This report is obviously just for the project capital expenditure and the portfolio across council. There are a few points of interest. The council program for this year for 2024-25 was 186 million, and it's broken down to the three main project types. Obviously, capital projects of 163 million, operational business as usual projects of 23 million, and emergency funding of 2.3. For the remainder of the council report, we'll be talking about just the capital expenditure. So that is 159 million. And to the end of June, we'd completed 133 million. So budget savings of 12.9 and a carry forward of 18 million or 11%. Just adding a bit more information around that. We're obviously on a bit of a journey with the capital team. We've got to do a bit more work in the next 12 months around forecasting, so that's probably one of the main areas we've sort of fallen down on a bit. We've got a lot of improvements which we're bidding in, and one of the updates on that is we've now got the staff trained in using the National Forward Works Viewer. So this means that all the projects we've got, the team can put them into the system, and it will be visible to all the utility providers across basically New Zealand, so anyone will be able to see what projects we've got going forward and when. And this also at the moment now links to our Apex 2, which is where we have our sort of project management information. So it's a good improvement for us. I'll pass over to Peter.
So the 133 million of capital works that was completed equates to 89% of our capital target budget. Compared to last year, we have completed an extra $37.4 million worth of works, which equates to a 39% increase on previous year's total spend. We've dropped our carry forward assumptions from 27 million to 18 million. This is primarily due to increased completed works, the water CCO keeping to their annual plan budgets and not carrying forward anything further, and us removing the $5 million provisional carry forward that we included in the previous report. These carry forwards have been integrated into next year's annual plan, so our total capital budget for next year remains unchanged at $145.8 million. Cam?
So as far as the carry forwards go, the 18 million is split up into $2.7 million in the Five Waters area, 6.6 million in the Parks and Reserves, 3.2 in transport, 4.3 in the facilities area, and 1.3 in resource recovery. So considering the budget savings of approximately 12.9 million, that's in table 3 in the report, and the majority of that being the Five Waters, with about 6 million, and transport of 4 million. So just going over two of the projects that we are tracking. Main one, which is quite a good news story, is Ellesmere Pines. At the time of writing the report, the project was well ahead of schedule, and you may now well have seen that it's 4 months ahead of schedule and it's been completed this month. As at the end of June, the savings were looking to be 6 to 7 million, and that cost has now been sort of realised, and it's looking to be closer to 9 million. Prebbleton roundabouts, obviously we're still working through that one. We're in the last phases of the project property negotiations, so hopefully in the next couple of months we'll be able to realise the final cost for that project. And lastly, I'd just like to recognise the team who have been delivering the projects over the last 12 months. They've done an awesome effort and put us well ahead of where we thought we were going to be. And including in that is also as well as the immediate capital works team, just the IMP team themselves as well, and also the finance team with Peter and co assisting us in that delivery.
In terms of Apex and our forecasting software, Apex has now been rolled over to FY25-26, and the new Magix projects module has been successfully integrated, along with upgrades made to our Power BI dashboard to allow our project managers to better track their spends at a per project level. We've also adjusted our purchase order raising process to allow for any committed spend to come through to our reporting to identify earlier if there are potentials for overspend against budget. Are there any questions on the report?
Open the floor for questions. Councillor Hassan. Sorry, to interrupt you. It's out of order. Sorry, Councillor Munt, you were first. My apologies.
Sorry.
Colourblind to colours.
On page 61, you've got the Prebbleton roundabouts defects periods are moderate. In terms of the going over budget, was that, because we have had some reports back on that through the Times, my understanding was, and I just wanted clarification, was that due to the increased costs of purchasing the land, or have we had some other shifts in the budget of late? There are some additional changes.
In the previous reports we've discussed, so there's a number of reasons around it. So one was the unidentified ground conditions, so they found a whole lot more contamination than they thought. There were also some additional costs for underground servicing for that as well. And obviously there is a lot of property purchase involved in it, which is more than what we originally thought we were going to have to purchase.
Right. So in terms of contamination, obviously we've had a good look at this with Whareroa. So there's nobody living on a roundabout. So why is contamination an eroding issue even?
I think any contamination is an issue. We were excavating. So sometimes the contamination might mean that it's material that means doing the compaction for the road to meet the requirements might not be right. So if you had sort of clay surfaces or something that doesn't work so well, they might have to remove that. So that's also classed as contamination,
that's
as
classed
opposed
as
to
contamination. Right. Okay. Okay. Thank you.
Councillor Hassan.
I've just got one question, and thanks for the clarity of the report. Figure 1, where we've got the carry forwards for the projects, and we've got the budget savings with the blue line. With those carry forwards, how much of an impact are they going to actually affect the following year's planned capital works?
So when we redid the annual plan, we had around $18 million worth of carry forwards built into that annual plan. So some of those carry forwards have shifted due to works being completed earlier or later, but in total, it has not actually affected materially our overall plan for next year.
Councillor McInnes.
Yeah, this one's not a question. It's just a big shout out for completing 89% of the Capital Works project. Like, we don't have a particularly good history on completion there, and this is really good. And yeah, maybe we'll get to 100% one day, but you never know what the future will bring. But 89 is really good. So thank you to everybody involved.
Councillor Glidden.
It's along the same, it's really nice to see some budget savings and value engineering that's going on within the team. So I appreciate seeing that and the work that's been done regarding that, and also delivering 89% is a big change for us in the way that we're operating. And it leads me to say, well, then are we delivering 111% next year? You know, like, this is the pressure that is put on our capital delivery program too. So I know that you have gone through and looked at the dollar values associated with this, but it leads me to the space that do we need to rationalise the CapEx program again so that it is actually deliverable in the next financial year. And Peter, you said that there would be no change to the dollar associated to next year's capital spend, but if we're seeing, what I'm seeing here is a $10 million reduction anyway in carry forward. So we've budgeted on $27 million of carry forward, but you've value engineered that down.
So when we budgeted, we actually only budgeted for 18 million.
Right.
As we got closer, we thought that carry forward was going to be greater, but due to the increased works that were done in the last few months, the extra carry forward that we thought we'd have to carry forward wasn't required. So we actually ended up in line with what we planned for the annual plan.
Okay.
And as far as rationalising the projects, we do that on an annual basis anyway. And I think the level that we've got in terms of delivering for next year is very similar to what we've delivered this year. Early on in the year, we looked at next year's projects, and there were a number of projects that anything that's had sort of high risk or had property purchases has been pushed out a bit anyway. So I think we should be all right with the level that we've got there.
And I guess the pain in that is Cam, when you say we get to rationalise it, it's you guys as the capital project team, it's not us around the table, and so that's where I think the frustration from me sits, has been across what that rationalisation looks like. And yeah, so to not have the opportunity to do that is hard for me around this table.
I recognise Mr Mason wants to speak, and I'll just add some comments which may help him as well. First of all, I think congratulations on the Ellesmere to Pines pipeline. Bringing it in under budget is to be commended, but the overall real win is the improvement in environmental outcomes for the Ellesmere ward and the environment. So there's a double win here for us. So well done. And in the same bet, I went to the resource recovery park. Our reuse facility now is, with solar energy attached to it, is really successful and has really certainly turned the dial on some of the things we offer here. I guess the question I'll put to Mr Mason to add to the questions he's probably going to reply to is it's always the challenge of quality and cost control versus percentage delivered. And while attempting to get to 100%, you also want to manage that expenditure in a really high quality way. And the other thing I probably would comment, which maybe Mr Mason will comment, is how much of that balance of 11% is work in progress, because nothing finishes on June 30, so there's a percentage that's work in progress, I guess. But Mr Mason.
Thanks, Councillor Miller. Look, first of all, big thank you to the team for what they've delivered, and really appreciate councillors acknowledging that today. This has always been about incremental improvement. This is probably a bit more than incremental improvement, to be fair. Delivering 38 million more essential infrastructure this year than we did last year is a massive step change for us. We've still got a lot of work to do. There's a lot of work to do around our systems and processes to continue to support the team. The team have already talked about forecasting. When you look at what we're delivering next year at 145 million, we think that's achievable. That averages out at around $11-12 million a month, and I think we can do that. There's some things that need to continue to happen to support that. Forecasting is a big one for us. We should be looking at what we're delivering every month and looking forward and adjusting our delivery on a month-by-month basis. And what I'd like to think is we can bring some far more accurate reporting to this council, and we're working on that at the moment, and that'll come with an improvement to our systems and better visibility of what we're delivering. So we're in a good place. We're comfortable with our program for next year. We believe it's achievable. And we're still putting in place lots of things that are going to continue to support that. I think that probably speaks to the quality versus delivery piece, Grant. It would be nice to say we're going to deliver 100% of our program next year, and that'll be the aim. But if I'm being honest, I've been involved in some pretty big programs of work, and we always struggle to deliver 100% of the program. So if we did that, we would be over the moon, but we'll be working towards that. As far as the work still in progress, Grant, I probably can't give you an accurate idea of exactly what that is. Peter, do you have any insight into that?
Not off the top of my head, but we could put something together if that's...
You don't need to, but I'm assuming that would take the 89 to close to 96 or something like that, probably. So there's largely a completion of capital works program, which is pretty impressive.
Yeah, that's right. Thanks, Grant.
So just, Tim, on that, the reporting that you're coming forward, I know that, the last few meetings I've been asking for more reporting and looking at what that capital is, and not necessarily the dollar spend percentage of what we're doing, actually the outcome that we're putting out and the value that it gives to our community. So there's just a slight different reporting in that, of actually going, instead of 89%, actually it's this many projects as well, and listing that. So I don't know whether the reporting that you're talking about that will be coming to us can show some of that, but I think it's really important to see that.
It is. It is. And look, there's a lot of reporting, really good reporting, that we want to bring to this council, and we will get there, preferably in the first quarter of this financial year. A lot of it sits with our systems. So we use Apex, and we compile all our project information into Apex, and then that generates reports. And we also use our master program to help support that. These are all things that we're still putting in place that aren't quite there yet, which makes it difficult for us to bring reporting like, for example, the movement of our projects through different phases, where they're sitting, and all the stuff we should be able to produce at the push of a button. We're working towards that. We're just not quite there yet.
I can just add to that if you like. Just to add to what you were saying, because the same thing we did last time. So the number of projects under 100K that we've completed is 168. 100 to 500K is 22, and over 500K is 9. But that's we haven't got the work in progress information yet, unfortunately.
Councillor Monk, are you still wishing to speak? No. Okay, so we've got a mover and a seconder for that report. All those in favour? Aye, carried. We're now moving to a resolution to exclude the public to receive a lease and investment report for reasons of commercial sensitivity. Your mover is Hassan and seconded by Reid. All those in favour, we move into public excluded. I will pause the meeting momentarily while we